uh, got it, sharing and what we're going to cover today. So we're going to just cover, we're not going to get into all of these things, but I wanted to give you an overview of the things that are really important to finance. So the results that you see is a profit and loss or an income statement. It is a balance sheet, is a cash flow statement. Most of our time is spent in the profit and loss, so that's why we're going to go with that one first. But finance also affects our resource management. It affects what does the future look like? And it's about creating value for our owners as well as our team members that are in the organization. So we are going to cover the P&L balance sheet and kind of high level on these items. So the first things first with the profit and loss statement. So profit and loss and income statement are interchangeable. You also in the nonprofit world, this would be called a statement of activities. So no wonder finance is confusing, is there's three names for the exact same thing. Income statement, profit and loss, statement of activities, all mean the same thing. And the very simplest form to think about when you're thinking about your profit and loss or your income statement is how much money did we bring in by providing a good or service, and how much money did we pay out in doing that, and then what's left at the end of the day, and hopefully that number is positive. So first is the revenue section, and some of your guys' revenue sections could be one item or they could be many items. Some of your organizations have multiple product lines. Some of your organizations have multiple income streams, and those are going to look different depending on what your business needs are. Now, these can be super complicated, or we can make them super simple. And why they get more complex is because people want to be able to take that data and use it to make management decisions. So in the case of having multiple product line mini P&Ls is to understand which product lines are providing value for our organization. So if one's not doing well and the other ones are doing well, then we need to at least have that information to make strategic decisions. Now, if there's pieces in that income section that aren't performing the way that they should, again, that just becomes a decision. And what I like to say about financial statements is they should be a mirror of what you're experiencing in the business. So, and it should be the story behind what has happened in the business. And that story starts with how much did people pay for our good and service? So that top line on the P&L and income statement is sales. The next section of the profit and loss and income statement is the cost of goods sold. Some people refer to this as COGS. And if you're in manufacturing or in retail, it literally is cost of goods sold. If you're providing a professional service, they just take out the word goods, and cost of sales would be the other acronym or frame of language in that. So at Light Consulting, we provide a service. We exchange time for money. So we provide accounting services. That's the bulk of what we do. So our cost of sales is what is the cost to be able to generate that revenue? Why this matters. This is very important because it helps us understand from an industry, where do we lie? And because we can do cross industry comparisons. We can take our product and say, in our market, so in the Midwest, in this industry, we should have margins of X, whatever that is. So, like a general contractor, their margins are going to be somewhere between 5 and 10%. Sometimes if they're specialty contractors, their margins should be more like 8 to 15%. If you are a retail business, your margin should be no less than 50%. If you buy something and you sell it for no less than 2 times the cost of it. In the professional services industry, our cost of sales should be no less than 33%. So there's a three times rule when it comes to professional services. And granted, it might be different than that, and that is okay, but having those metrics and those numbers help us understand where do we need to focus our attention in our business? What decisions do we need to make? Say that we are doing a line of business that is consistently below industry average when it comes to what the cost of goods sold, either are those market forces that are doing it? Are we doing a bad job? Or do we need to control our costs? And by seeing it this way, we're able to narrow down our energy so that we can really understand what that gross margin, gross profit is, and really understand, is it a labor thing? Is it a material thing? Is it market driven, meaning like the market is not demanding or allowing us to charge the price we need to get to the margins? That mean we want to stay and continue to play in this market? Do we want to explore other markets? Or do we want to shift some of our costs so that the margins are more in line to what we need? The beautiful thing of what we've gone through in the last 5 years with COVID and then coming out of COVID and the tiny baby recession that we had in 2022, but we also had an influx of cash, is the things that we've experienced in the 20 years prior to that maybe aren't as consistent. So we may be experiencing one thing and the numbers are saying it different. Spent some time at the Chambers Economic Summit this morning, and that was very apparent in how small businesses are viewing the economic system and saying that it's not great, and the data doesn't show that. And I even had a client say, all my their client that client is a marketing firm, and they said all my clients are doing worse than before. And I'm like, I don't think that's consistent with what we're experiencing. So we went through our client list and year over year, and things are bad for a few, but better for most. So because we were used to that little blip in the cash infusion, it's throwing things off. So that's a sidebar of all the cool knowledge I got today. But so when it comes to understanding your P&L, this is so important because I think it's so interesting when you have side talks and you're like, yeah, we're $100 million company, or we do $1 billion in sales. The two people that were on the stage today, one is was Doosan Bobcat. They do 7 billion in sales a year, and their Doosan, the parent, does 14 billion globally, and the other one was like 30 billion or something like that. And that's just a number, but that number isn't good or bad. It's just information. And once you start doing some of the math calculations that we talk about in Finance Simplified, you can understand, is that good or is that bad? And really the meat of understanding financials and good and bad is in the comparison. So we'll get to that in just a minute. Like right now, we're looking at this upper part of a P&L or income statement, and we have one year and we have the other year. So we can see that sales, and usually the most recent year is closest to the words. So we have sales of 1,976,000 this most recent fiscal year, and the year before that we're at 1.4. So sales went up, which we assume is a good thing. Now we look at the costs that are a part of that sales. So in this particular example, this is a service-based business, heavy on wages. There's some other things that go into that. Apparently, these people take their people out a lot, with the meals and entertainment and travel being as high as they are. But our cost of sales in this most recent year at 853 versus 611. So our margin from this current year to last year went from 57 to 58, or was 58. So actually, we have a little bit of a decline in our profitability from one year over the other. So we had an increase of sales of over 25%, but our margin went down just a little bit. So this is a pretty consistent year over year. What they're probably feeling is what we call wage inflation that we're experiencing or did experience heavy in 22, in 23, and now it's leveling off a little bit. The next section of the P&L is overhead. They also call this expenses. They also call this SG&A, which stands for sales, general, and administrative costs. So this is everything outside of what it costs to produce your good or service that you're selling. So this will be like corporate office rent or in corporate office anything, but it would be like rents or legal and professional fees will fall down here. All of those things that are part of running a business, but not necessarily part of producing the product or service that you're providing. And that all gets in overhead. This example is a retail company. And again, look at it year over year. It's super important to say what was the increase in wages. This would be indirect wages that caused that to go from 113 to 176. And this is where analyzing your financial statements, because at the end of the day, this is just black ink on a piece of paper. Hopefully it's black, not red, right? Uh, but looking at it year over year, did I expect this to happen? Is it what I budgeted to happen? Is it in line with the industry that I'm in? All of those things, questions help you make better management decisions. So that's why these things are so important. We put so much time and effort into accounting, besides the fact that the government says we have to have some type of accounting to be able to pay taxes. Another way to visualize this is putting these in pie charts. So what is our overall employee costs, facility costs, sales and marketing components piece of the pie? Because now in an instant, my brain can process that as the pie as a whole, we're spending more on employee costs in 2020 than we did in 2019. Our brains can process visually 60,000 times faster than we can written or verbalized communication. So when we're able to put the data into charts like this, it's super helpful for us to um, process that information quicker. So again, with the terms, this is again, we're still on the P&L income statement, statement of activities for those nonprofits. Net operating income, as also known as EBITDA, which is earnings before interest, taxes, depreciations, depreciation. Did I get all of them? And amortization. Yes, you can just see I should have capitalized just the letters that stand in the EBITDA. And this is important because this is how much money we made as a business before those other things, and why we have this number before the other things, because the other things are real-ish. They're a little bit more manipulated from an accounting standpoint than everything above the net operating line. Everything above net operating, the amount of sales, the amount of cost of those sales, the amount of rent we paid, those are pretty black and white. There might be a little bit of accrual adjustment at the end of the year, but those are very black and white. Everything below the line shifts a little bit depending on the structure of the business. So the type of business it is, a C Corp, an S Corp, that stuff will determine taxes. How much debt you have will determine interest. How much fixed assets you have will determine your depreciation. And how much goodwill or loan amortization, those type of things will determine that expense. So we as operators really want to look at that net operating income or the EBITDA and above, because those are things that we can control in the period. What I mean by period, it could be a month, it could be a quarter, it could be a year. The things outside of that are things that are less in our control in the period because they are influenced by things we've done in the past or decisions we're going to make in the future. So that's why this number is so important. And again, with industry standards, what MANCO, RETCO, and SERVCO stand for is manufacturing, retail, and service. So these are three different industries. They're not really industries, but three different sectors where the financials look slightly different. So I wanted to give those different examples because at manufacturing, you could make a really high percentage of sales. That's what those little 17% are. Or it's low, depending on what you're manufacturing. Maybe there's a really high cost to manufacturing said good, and maybe not. Maybe if you've watched Shark Tank and they ask what's your cost to produce, and they say $2, and then they say they're selling it for $49.99, they got some good margin in there. Maybe they're dropping 17 to the bottom line. Maybe not. And then when it comes to retail, that again is going to be ebb and flow. What actually are you selling? Are you online retail? Do you have brick and mortar? Are you in the bar restaurant business? All of those things are going to influence that. But without understanding where your net income or your net operating income is, then we can't compare that to other organizations. And that comparison is the thief of joy. And it also gives us the opportunity when it comes to business to understand, are we doing a good job, or does it just feel like we're doing a good job, or are we doing a bad job, or is it really just the industry that we're in? So when it comes to examining your P&L, your income statement, your statement activities, you're always looking at comparative. What did we do in comparison to last month? What did we do in comparison to budget? What did we do this month in comparison to last year's this month? And why that's so important, it's most important here in our geographic location because our almost all of our businesses, even if you're in retail, are cyclical. Our buying cycles are cyclical. So even in retail, even if you're online retail and you sell hockey equipment, you're going to sell more hockey equipment during the hockey season. Like this, everything is cyclical. So it's important to look back the period. You don't want to compare January of 2024 to September of 2023 if you live in the construction world, because those numbers are going to be significantly different. If you're in the retail business and maybe you're in a flower shop business and you compare February to June, not even helpful, right? Because February and February should be compared because there's a big day where the most flowers are sold, probably more flowers sold than the rest of the year in February. So looking at those comparatives year over year is super important. So this data, when you look at it just like this, doesn't say anything. It doesn't say we're doing better. It doesn't say we're doing worse. It doesn't say if these are good numbers or bad numbers. It just is numbers. We're glad they're accurate if they're accurate, and we need to look at it comparative. So if we look at this particular one, this is retail. So sales went up from 1.2 to 1.5, so a nice increase there. And our total income still went up, not quite as much. And that's because our discounts went up significantly. They almost doubled, and our income did not double. So, did we expect that? Now, if we expected that, then that makes sense. But if we didn't expect that, then it's like, okay, what did we miss here? What are we doing? Did the customers take more advantage of discounts that we were providing? Or is there something wrong going on here? Is there something in our processes, our employees um, giving more discounts than what we anticipated or what we needed? So those would be all questions that can stir from and why analyzing our financial statements are important. And then if we pop down into the cost of goods sold here, going at 756, where we were at 615. Again, we have an increase from a percentage of net income from a net income percentage. The percentage is going from 59 to 65, which we don't necessarily want because the inverse of that is our gross margin, and we want more margin. So in this particular example, we did almost 300,000 more in sales, but at the end of the day, when we paid for our cost of goods sold, our inventory and all of that stuff, we actually made less money, 436 versus 461. And that's not ideal. We don't want to make more in sales and make less money. It's also not uncommon for businesses to go through these kind of waves, if you will, especially in good times when we're not paying attention and we kind of just let off of the analysis of our financials. Our margins can slip, and we just want to be conscious of that. Here is the year over year comparison when it comes to the overhead expenses. And then comparing to budget, this is also super important because a budget is merely a plan of what are we going to do for the next year. Likely that's mostly what people do from a budgeting perspective. And a goal without a plan is merely a wish. So I encourage you, if you don't do it already, to put together the budget and then put it into your system so you can run comparable financials. So that if your year over year sales, like this example, is higher than budgeted, and our discounts were also significantly higher than budgeted, is that good? Is that bad? Our cost of goods sold again was higher than budget. So did we anticipate that? Was that a shift in the market, or did we just not manage our cost of goods sold very well? Same with on the overhead expenses. Did we not anticipate hiring a person? That's why wages went above and beyond budget there, and depreciation and is on there as well, and that's kind of the other one that throws us for a little bit of a loop. So comparing to budget. The other one that, so whenever we do financial statements, we do them in those three ways. We do year over year, we do comparison to budget as long as the client has a budget, and then we do month over month. And what shows in this month over month is it gets us in a good routine of seeing that cycle that we experience in whatever industry we're in, because there's going to be a cycle, and your cycle is going to be different than my cycle, which is going to be different than everybody else's cycle. But understanding that, this also gives us the opportunity to identify if anything is in error here. Now, accountants love for things to be correct, and they're managing a crap ton of data. So when the data comes in, and they probably have systems set up to say if it's this, then it goes there. If it's that, it goes there. And sometimes the system gets it wrong. Sometimes human error gets it wrong too. So whenever looking at budgets, we always do it this way. We did a lot of rental real estate in my past, and we would always look at it this way, because real estate taxes come out once or twice a year, insurance is paid once a year. We'd be able to see that, but we'd also be able to see is, holy banana cakes, what did we do in June that was $20,000 in repairs and maintenance? Oh yeah, we flipped a couple of units. Those tenants were ran away or whatever, and we couldn't recover that cost. So we would be able to, that would be an outlier, versus if we were just looking at it year to date, it might not look that odd. But if we look at it on a month-to-month basis, or if you're missing a utility bill, if you're missing a rental payment, those type of things, then you can catch it before you get to the end and be like, oh, we made $100,000. And then you're like, oh, but we haven't paid rent for 6 months. How has our landlord not kicked us out yet? That's the benefit of looking at the financial statement month over month. Now, how do you influence these numbers? This is really what's important. And I'm spending the most time on the profit and loss statement because this is where most people spend the most time. So often people are like, ah, I don't know if I can really influence. You can influence all things. So when you're a member of an organization, do you influence sales? Absolutely you do, because you're an ambassador of that organization, whether that's good or bad. Hopefully it's good, or maybe you might be at the wrong organization. But saying, I can help you with that, we can help you with that, so call so and so. It might not be, if it's going to be out of your department, that's totally fine. But you're an ambassador that can be a positive reflection on that top line. How do you influence their cost of goods sold? Well, depending on what your role is, what is that number that makes that up? Is it labor? Is it inventory? Is it any of those things? Is it a process? So if it's labor, how do I make sure that we don't have a lot of turnover in the production side? How do we make sure that our costs are controlled if I have the ability to purchase things? If that's part of your role is purchasing things, making sure that you are getting the biggest bang for your buck. Not always going to the people who are the most convenient, but especially if I can save a bunch of money by going to somebody else might be a little less convenient than going here. So those type of things when it comes to influencing your P&L. Oh, I just said the different types of businesses. So that's a retail, here's service, here's manufacturing. You have influence over your P&L. Don't tell me you don't, right? The next financial statement. So that's the one, like big business, this is where they're hanging out. They're hanging out here regularly throughout the organization. You might have departments that get their own income statement. You might have sites that get their own income statement. And outside of this, the executive team or the ownership group, you probably don't spend a lot of time on the balance sheet. And there's a reason for that. The reason for that is because the balance sheet is more historical. It's less flexible. You can influence that P&L on a daily basis. Like I'm going to switch who we get our paper from because that person is twice as expensive as this other person. You can influence that stuff consistently and in a quick turnaround. When it comes to the balance sheet, that stuff takes a lot more massaging to influence. So that's why we spend a little bit less time in it from a business perspective, but it's no less important. And the third one, which most people don't even use, is actually one of the most important ones. So we'll get there in just a few minutes. All right. So basic concepts of a balance sheet. Now, there's only two names for the balance sheet. The Not unlike the income statement, which was the income statement, the profit and loss, and then for nonprofits, the statement of activities. For the balance sheet in a nonprofit world, this would be the statement of financial position. And for those who are in the for-profit world, it's a balance sheet. It's called a balance sheet because it has to balance. So that's one thing. Softwares can sometimes let you have unbalancing balance sheets, or some softwares don't allow it. They like give you a warning. And that was one thing that when I was in charge, our software before and when I was a W-2 employee, the software allowed us to be out of balance. So every time I saw a balance sheet, that's the first thing I checked. Like is this accurate? And how it balances is its assets, what you own, liabilities is what you owe, and then the equity section is what you're worth. And those three sections are on every balance sheet. The language is a little different in the equity for a nonprofit, and they call it net assets because your assets should be greater than your liabilities. All right, so how is this organized? How is the balance sheet organized? Both sides of the balance sheet, both the assets and liabilities, are organized in liquidity. So the current assets are the most liquid. So cash and cash equivalents are always at the top. Now, people are like cash in bank is basically interchangeable with cash. You might have cash in tills if you have a till, but when you see the number here, 285,000, that's not actually cash that's sitting underneath the mattress or in a vault at this manufacturing company. That means cash in the bank, basically how much is your checking account balance at this period end. And again, comparative is so important. You can see that at the 12/31/2020, we have 285,000 in the bank. The year before, we only had 12,000 in the bank. And that's not very much when you're trying to run a business. So it's important, but it goes from most liquid to less liquid. Our next most liquid would be accounts receivable. Those things, what we're getting from clients and customers, what they owe us. And it should be a fairly short cycle from when we sell something to when we receive payment for it. Those things that are next, there's sometimes other receivables like prepaid insurance is basically an accounting term. There's a lot of other prepaid expenses, not a lot, but a few other prepaid expenses. The other one would be inventory. So inventory is more liquid than equipment, but less liquid than receivables or cash. So that's why it sits where it sits on the balance sheet. And then I have the manufacturing company and then the retail company there too with cash and inventory. The long-term assets. So this is either intangible assets or actual tangible things you can touch and feel, including plant, property, and equipment. And PPE, now we don't use that in accounting as much pre-pandemic. PPE always meant plant, property, and equipment. During the pandemic, personal protection equipment is what took over the PPE name. So therefore, we don't really use that as much in accounting because PPE might be a line item on your P&L and it's confusing if it's on both. So this is our investments in equipment. A lot of organizations adopt a rule. So if it's more than 2,500 or 5,000, then it's a fixed asset. If it's less than that, we run it through the P&L as miscellaneous supplies or miscellaneous equipment. So this can be and what lives beyond this, so you see a number here of 250,000 of manufacturing equipment, is a asset list. So a list of all the assets that make up that 250, the date they were purchased, how much they were purchased for, and then there's an accumulated depreciation item that is on alignment with that. So say I buy a vehicle for $75,000 and I depreciate it over 5 years, there's only going to be a chunk of that. So say I sell it in year 6, that thing has been fully depreciated. It's still on the balance sheet, but it's the expense side has all been run through the P&L. So if I sell it for 25,000, now I have 25,000 of gain. And we like to keep all of those activities outside of the operating income and in the below the line activity so that you're not, because you're not in, unless you're in the business of selling and buying vehicles, those activities are different than what your normal business is. So intangible assets, those would be things like goodwill or loan fees are often called in, forced to be on the balance sheet and amortized over the life of the loan. Goodwill would be amortized over 15 years. So those are some examples of long-term assets, things that last beyond a year. When it comes to the liability section, this is what you owe. Current liabilities, you have accounts payable, credit card, payroll liabilities, and a line of credit that matures every year will also sit in the current liabilities section. Long-term assets usually are going to be, or sorry, long-term liabilities are usually going to be loans that mature more than a year. Now, the proper GAAP way to account for these things is to put the current section, like the next 12 months payment in the current section, and then have the rest in the long-term liabilities. If you're privately held, there's some flexibility in some of those calculations. And then we get to equity. So if we have our assets, what we own, we got money in the bank, we got inventory, and we have some equipment, and then we owe the bank or somebody some money, what's left? That's what your equity is. And this isn't equity of like how it says what you're worth, but this is what you're worth in a book value. So most organizations have a fair market value and then they have a book value. So, and the easiest way to understand this is real estate. So say that you guys are all adults, I'm assuming, on here. So we've all probably purchased real estate or thought about purchasing a home at some point. So your book value of your home is what you paid for it. So say that I bought a house 5 years ago for $250,000. That's my book value. And at the time I took out a mortgage for 200, now it's paid down to 150. So I have a book value of my asset of 250 and my mortgage is 150 because I paid it down. So I have 100,000 of book equity. Now my house could be worth 500,000, which then my equity is a lot more, or my house could have went the other way, which doesn't happen very often in real estate. And my asset value is less than my actual book value. And so when you look at an equity section of a balance sheet, it's basically the equalization of what's been going on with the assets and the liabilities. So sometimes this is negative, and sometimes, and most often, we want it to be positive. So it'll include capital contributions, it'll include
Billionaire.
distributions, and then it'll include retained
Mm,
earnings and the current year net
mi
income. So
madre.
how much is your business generating outside of the asset activity? That's really what is hanging out in the
Ok.
equity section. So how do we look at our balance sheet? Our balance sheet we look at in a
Um,
same comparative comparative balance sheet is how we want to look at these. So again, year over year, if cash is increasing or decreasing, did we anticipate that? And really, this is just historical financials are proving out what I expected to happen happened. And if what I expected to happen isn't happening, it isn't reflective, there's something wrong here. Either could be an accuracy in reporting, but also could be in the processes and procedures that are going on. So I might think that everything's under control in my organization, and the numbers might tell us a different story. So it's really important to look at these comparative year after year. And why that is because the balance sheet is where all of the secrets lie. And why they sit in the balance sheet is because the P&L turns itself over. The income statement turns itself over every year. You get to wipe your hands clean. Last year we sold $1 billion and spent 800 million, so we had 200 million in net profit. That's last year's. Now that number goes into the equity section of the balance sheet, and the balance sheet lives on forever or for the existence of the business. So this is a couple of years old now, but this gentleman fabricated sales and said that there was cash in the bank. And the so most all publicly traded companies have to have a third party audit. This is how Enron and WorldCom ended up going down is during their third party audit. Well, actually, the accountants were in on it. That's why Arthur Andersen doesn't exist anymore. Uh, but you have to have a third party audit. And during this third party audit of this particular organization, it actually took them way longer than I am proud to admit, not proud to admit that the accountants didn't find this sooner, but missing $2 billion. So they inflated sales, said that they had cash in the bank in this bank account, but it didn't exist. And through the audit process is when they found it. So people investing in this business are like, oh my gosh, this business is killing it. It's returning all this money to the bottom line, but it really was just fake money. It wasn't real. And that's where, when I say all the stuff that hides when we have fraud, it's in the balance sheet. The next story is back in the 80s. We had this gentleman, Crazy Eddie. I didn't know him. I was born in the 80s, so I didn't know this, but reading up on this story is super, super interesting. So Crazy Eddie, he was in the uh, appliance reselling business. So he would buy appliances and then resell them. And during when he was privately held, he was skimming cash. What that means is he would sell his products and not report all the income. So, because he didn't want to pay tax on it, right? So, he was not reporting all of his income. And then he had a better idea. So, his cash, as far as balance sheet goes, was accurate, but his sales were low. He wasn't making money when he should, based on the amount of inventory that he was turning. So he was not reporting the right amount of income so that he wouldn't have to pay tax. But then he had a better idea. The better idea is to do a little bit of what that last guy did, and we're going to inflate sales because I want to go IPO. So Crazy Eddie decided he's going to expand his network. He is going to have all of these store locations and he is going to go to the market and cash out on his business that he created. So he did that. He overinflated inventory. So he didn't use cash as his item because he knew auditors are going to check and you have a third party bank statement that's going to say, no, you only have $10 here at US Bank, not the million that you're saying on your balance sheet. So he was a little bit smarter in that he overstated inventory. So he was saying that sales everything in accounting balances. So he was saying he had all of these sales. So then he was having all of this income drop to the bottom line at these itty bitty inventory or cost of goods sold number. And the debit to the sales credit, he hid, if you will, in inventory. So when he went to market, I don't remember exactly what it was, but I think it was like at $18 a share. And when this hit the news and they figured it out, ended up trading at $1 a share. So those people who invested in Crazy Eddie did not have their money returned to them. So keep in mind, if you're not looking at your balance sheet, it is important. It influences your business. So we talk about, that's on the asset side. So that was overinflated sales. And then, so that's a credit. The debits are on the asset side. So cash, accounts receivable, inventory. That's where we'll see the sneaky stuff hiding. On the AP side, we see that number growing, and it doesn't make sense as to why that is, whether that's accounts payables growing, our credit card liability is growing, our bank loans are growing, but we're not growing our assets when it comes to buying more stuff. That also could be a cause for concern. So your AP or your other things can grow if you're managing cash. So say you actually have a cash shortage position, you're going to extend your AP process. So say that we were paying net 30, we're paying our full bill every 30 days, and you have a cash situation where you'd have to go to the bank to borrow, but your suppliers are going to allow you go to 60 days without any additional charges, then your AP might grow. But again, that should be a strategic choice that then is reflected in the financial statements, not oh, I wonder why that's going on in our financial statements and not the choice before. So this is reactive versus proactive. Um, so those are increases in our accounts payable, other payables. Decreases in your accounts payable and other payables, it means you're just paying those faster, which can be beneficial, especially if you're heavy on cash. Your highest and best use of cash often can be reducing your debt, especially with the high interest debt that we currently have. So right now, if you're into your line of credit and you're paying 10% on that line of credit and you have hundreds of thousands of dollars sitting in your bank account and you're like, "Oh, I just really like to see that number really high." Well, that number is actually costing you 10% of whatever is in your line of credit. So say you got 200 in your bank account and $100,000 line of credit at 10%, you're paying 10 grand just to hold that over there because it makes you feel good. Like that's not always the best decision. Line of credit doesn't go away just because you paid it down. You want, if you paid it off and they closed the loan, then you don't have access to it. But decreasing isn't the worst thing in the world, which brings us into the cash conversion cycle. So cash is king, and this is probably where I'm going to end, is because I want to create an opportunity for any questions as well. But the cash conversion cycle is basically the business cycle and how quickly we turn things into cash. So we sell a product or service. Sometimes we get cash at the time of sale, think bar, restaurant, right? I mean, you might wait a day on your credit card payment coming into your bank account. If you're in the medical business, you have insurance. If you're in another business where you allow customers to order things, you then have AR. And there's a gap often between when we sell something to when we collect the money for it. And then we take that money and we go make purchases. And then there's a gap from when we get the good at the purchase to when we actually pay for that good. And then if we have inventory on that, then we paid for the good and probably the labor that went into it. And then the inventory hold period also influences cash before we sell it. And this cycle continues over and over and over again. So inventory, payables, and receivables, those are balance sheet activities. The selling it, the purchasing it, those are P&L and income statement activities. So the cash conversion cycle and the cash flow statement brings both balance sheet and income statement together and says, this is what happened to the money that came into the organization. So when we want to, I'm going to skip into a couple of slides where we talk about how do we control this. Okay. So if you want to increase your cash, because now the cost of cash, the cost of money is so much more than what we were used to experiencing 2 years ago when interest rates were in the threes to fives, and now they're in the eights to tens. So cash conserve conserving cash is important. Cash is king. If you went to business school and they didn't tell you that, they should have told you that it is important to have cash. So how do you increase your cash conversion cycle? So these are the levers in which you get to pull on via policies, via operations. How do we move that? So our collection time, we can reduce that. So if you are providing a service, then you can say payment due at time of service versus I'm not going to let you charge. I'm just going to, I mean, I don't get a charge at the grocery store. I get to collect from that right then, right? So you can make that. That's basically a business decision, and you just make that decision and then you reduce that holding period where you provided something and all the headache of collecting AR, reduce that down so you get the cash faster. You can have conversations with your suppliers and increase your pay period. So people use this in small business, they use credit cards because they can swipe their card and not pay that for 30-ish days, versus swiping debit card where it comes out of the account immediately. So we can utilize credit cards, we can utilize negotiating with our suppliers and increase that AP period from when I got the good to when I actually paid for the good. And then we also want to, in that process of the levers, if we decrease our inventory hold period, we also increase our cash. So, for example, let's use retail for example. We all go shopping, or for the most part, I'm assuming we all go shopping where they buy product. Let's just say let's use like a clothing retailer. So they buy product, they have product in their store and say that they buy the product on 30-day terms. So the day it's shipped is when that 30-day meter starts. Maybe it's to you by day 5. You put it on your floor on day 6, and maybe you're really good at sales, and you sold through 80% of your inventory in 10 days. And this was a pay 30 term. So I now 16 days in have sold and have the cash for, because we only accept credit cards, you don't buy on credit here, 80% of our stuff. Then there's that 20% that's kind of that hold period. And I have margins of 2x, 3x, 4x. This is how I pay to buy more inventory. And this is how I return a lot of money to the bottom line, is utilizing those different pieces in this cycle to increase your cash and to decrease some of your need for financing, your need for basically it's that for the financing piece. Because if we can figure out how do we get through the cycle, now you need that initial money to buy the inventory. If we can reduce the cycle, then we are cycling cash faster, and that's good for your business. Now, sometimes there's a time where we don't have all the control, right? There's a lot of things in business that we have influence on, but not full control. And that these things might go in the opposite way. Maybe we have this happens lots in construction, where we have a really big project and we have a slow to pay customer. That makes it difficult. So then you think about, what can I do to increase that payment? And this is why contracts are so important. What are the terms? They have to pay on 30 days. And then do I want to flex that muscle and all of those things? So it can be complicated, but this is what I wanted you to get away from the cash conversion cycle. It's the balance sheet and the income statement working together to cycle your cash. And this is what business is. It's just a cycle of cash. And sometimes you can take little pieces off and return it to the owners. That's the intent in for-profit businesses, to get a return for your owners. So that's what I want to cover in the 1 hour of Finance Simplified. And I got my screens like on top of each other. Who has the first question? I know I covered a lot in 40, 50 minutes, so if you're still just digesting, that's okay too. Well, given there's no questions, I hope you guys learned something new today. And like I said, Drew recorded. Thank you, Drew, for doing that for us. So she can send out the recording if you want to come back to it again. I basically word vomited finance on you, trying to make it as simple as possible because it is complex. I don't know if we intentionally do that for job security, but we do have a lot of terminology and different things from a industry specific. But thank you for your time today. I hope you have a great rest of your day.
Thank